All right, welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry with Ryan Kimmel.
Yo, yo.
It's just after 10 a.m. here Pacific time on September 5th. We had our first NFL game of the season last night, along with a nice 1 hour lightning delay that made it almost my bedtime before the game finished. So luckily we're on the West Coast here, Ryan. So it was, we didn't have to stay up super late.
Definitely nice to have a little bit of football on, gotta say.
That's right. Let's get into the where are we for the week. Try to keep things tight here. We have the S&P up about 25 basis points for the week as of time of recording. It looks like it's down. Let me see. Most of that's today. Negative 50 basis points here today so far. So it was a pretty good week going in before today. Looks like the big winner was communication services up over almost 2.75%. Consumer discretionary up 1.5%, and healthcare up 30 basis points or so. Those are your big winners there. Your losers, energy is the big loser, down 3%, along with financials down 1.5%. So kind of a mixed bag there from the stock market, as you would expect, given you're only up 22 basis points for the week and for the month. The Russell 1000 is up also similarly a quarter point. Russell 2000 doing better, though, up 80 basis points on the week. Growth positive 70 basis points. Russell value actually negative 17 basis points here as of time of recording. And S&P equal weight down 30 basis points on the week. So overall, just a mixed bag from the stock market. We did hear that bad news is actually bad news today. But, given that it's only a 50 basis point move in the stock market today, we'll have to kind of see whether how that shapes out here on a go forward basis. If we shift gears to the bond market, rates were down across the board. 3-month, 2-year, 5-year, 10-year, 30-year, all negative in terms of your rate move, so positive in terms of your bond market. 10-year down 16 basis points. We're now at 408 on the 10-year. 2 years down 14 basis points. We're at 349. So not really, a pretty parallel shift here in terms of rates, with the 3-month 10-year actually coming in by 2 basis points. Ag turned in as you would expect, given that longer or that kind of pretty good move there in rates. Ag up 1%. Treasuries and agency mortgages both up 1%. Your big winner of your traditional sectors is your investment grade corporate bonds, up 1.3%. Kind of, as you would expect, given what we'll get to on the macro side here. High yield up only 20 basis points. Bank loans up 10 basis points, and EM up 90 basis points. So green across the board there from the bond market across all different sectors here that we track here on the Minutes podcast.
Yeah, it's kind of interesting to see, post that macro data we got this week. You got the 2-year moving to the lowest levels in 3 years, and that range bound 10-year yield finally kind of broke to the downside. We're back to where we were kind of during the depths of the Liberation Day. And long end even is finding a bid after kind of kissing 5% earlier in the week. It seems like there definitely is, demand once you get to that 5 handle for the 30-year. And it kind of just hit that level kind of overnight. I think it was like a Wednesday night. And now we're back here to like 477.
That's right. And, looking at the 10-year chart, it's broken down, but yeah, you're right. Almost to that Liberation Day level, but, we've been at this like 4% level a few times here over the past few years. So the 2-year chart really is the one that's, you haven't been at this level for 3 years now. And that was like kind of the skateboard ramp up there off the 2-year base back in 2021, 2022. So, it'll be interesting to see how that continues. Certainly with the Fed cutting, we would expect 2-year rate to continue to fall.
For sure.
Finally, commodities flat on the week. Looks like precious metals the big winner, with gold up 4%. Industrial metals down 40 basis points or so. Crude oil down 3%, which is kind of why it was dry. Which is why the energy sector was so negative. We do have a OPEC plus, or one of those OPEC meetings coming up on Sunday, and the speculation is that they're going to increase production. That's why oil is down now $1.70 today. We're at 61.80 here as the time of recording on WTI crude oil. Finally, the dollar, the dollar index is at 97.6. So down about a pretty big move today, down about 70 basis points today, 20 basis points on a week. That's it for the market roundup. Ryan, you want to get into the macro side of things since it was a busy, important week?
Yeah, definitely busy, important week on the macro front. We did get an update on the health of the labor market this week. We got a number of kind of labor-focused economic indicators. And, when you aggregate it all together, it's definitely painting a picture of a labor market that is softening on the margin. Some analysts are saying we're getting to this kind of stall speed on the labor market. But having saying that, I wouldn't say that the labor market data or the conditions are really like falling off a cliff. But the main event on the week was this morning, the jobs report for the month of August. I'd say coming into this number, I think the market consensus was already, pretty muted, expecting, pretty a weak-ish number. But the headline number actually kind of disappointed already low expectations. So if you look at like the headline number from the establishment survey, showed that the economy added only 22,000 jobs for the month of August. That was well below the consensus of plus 75,000. And again, we saw downward revisions to the previous 2 months of 21K. Not as dramatic as, what we saw at the last report. But, when you tie all these revisions into the data and try and get a, good read on the labor growth trend, the 3-month moving average of private payrolls growth is only at 29,000 per month. So, that is a cycle low and kind of well below kind of the run rates that we saw, pre-pandemic. When you look at the underlying details, particularly on like the establishment survey, they're not very constructive. Um, you know, the job gains and job growth are, it's very narrow, meaning that we're only seeing a few select industries and sectors really kind of contributing to job growth. If you look at like the goods producing sector, we saw a decline there of 25,000, and it was pretty broad based. We saw declines across mining, construction, and manufacturing. And you're really only seeing the job growth in the services sectors, and particularly, it's coming from like one or two sectors. So education and health services kind of continues to be the only, bright spot where we're adding growth, or labor growth. One interesting data point is if you look at like the year to date private payroll gains, um, over 88% of those gains are coming from the education and health services sector. So that, that doesn't really paint a, a very robust picture of the labor market. You really want to see, multiple sectors kind of contributing to job growth, particularly, your more like cyclically sensitive sectors. And, I would categorize education and health services as much more of like a kind of like defensive sector. So, you don't really get a good read on kind of like where we are in the economic cycle. On the on the household survey, also kind of a weak read. While we did get an increase in employment from the household survey, and so this survey that, they're polling actual households. We did see a rise in employment of 288K. But that was largely driven by part-time employment. If you actually look at full-time employment, we actually saw a decline of 357,000 jobs. And this is a pretty volatile number. So when you look at like the 3-month average of the, household employment gains, you're only running at like 40K per month, which is more or less kind of in line with what we're seeing in the establishment survey. On the unemployment rate, we did see that tick up to 4.3, which is a cycle high. And that was in addition to the participation rate increasing as well. But if you look kind of pull back, we have seen pretty significant declines in the participation rate over the last couple of years. One measure that I've been paying particularly close attention to, and it has been pretty strong up until kind of this month, as like your aggregate payrolls income growth, which basically takes into consideration, your total number of jobs times your, weekly hours work times your average hourly earnings. And, if you look at like 12-month growth rates, those are running around above 5%. Um, the last month, and we've seen that kind of trend lower into the four handle, and if you look at like more and high frequency growth rates, like the 3 month, that dropped to 2.4. So that's definitely something I'm watching, and very important for kind of consumption going forward. You need to see strong kind of payroll growth or payroll income growth really to support consumption. So as we saw the market really react to this weak number. You saw the treasury curve kind of bull steepen out, 2-year yields declined. As we noted earlier, you saw the dollar decline as well. That was down almost 1%. And risk assets, I'd say, general kind of a risk off tone there. Um, Other data we got during the week, mostly labor market focused. Earlier we got the JOLTS data, the job openings data for July came in below expectations. We saw that decrease to 7.2 million, which is below the consensus of 7.4 million, and kind of the lowest level we've seen in over 10 months. Interesting, the pullback in job openings was in like the healthcare sector and retail trade. So, um, that is, could be, maybe a warning sign, especially because that's like kind of the one sector where we're seeing growth on the payrolls. And then I'd also highlight, this theme that we've been talking about in the past, where it's just this like low hire, low fire. Kind of labor environment where you're seeing hiring rates really come down to kind of well below where we were kind of in the 2018 2019 era, but we're also seeing firings come down as well. They're pretty much right in line with each other, so it's just this really like low turnover, very static kind of labor market that we're seeing. And it also highlight too is like when you look at kind of labor supply demand dynamics, which you get a good read from the JOLTS data when you look at like number of job openings to the total number of unemployed. That ratio has finally dipped below 1, signaling that the labor market is back into a better balance than when we were a couple of years ago, which ultimately should kind of help take wage growth, inflation, back down to kind of where we were pre-pandemic. Um, and then you're also, I'd call like more tier two data during the week, but the employment components of the ISMs, both from the services and manufacturing side, those are both in contractionary territory. We also got a read on ADP, which actually might be more interesting these days if we're going to see, significant changes from, the BLS data. And that's kind of signaling a similar picture where you're for the month of August, saw employment increase by 54,000. And when you look at like the 3-month moving average, that's running at 46,000 per month. So again, kind of painting this picture of, slowing labor growth. And then ultimately, and every week we get the initial jobless claims where we actually did see a bit of a pickup in initial jobless claims to 237,000, which brought the 4-week moving average to 231K, which is an uptick, but it's nothing really alarming. And we say this every week, but when you look at like the continuing claims data, it is gravitating higher. And it's just really signaling that, for employees that are getting laid off, it's just taking them longer to find jobs. So that wraps it up for the week on the economic data front.
Yeah, I thought it was interesting, Ryan, when you're looking at it as we were going through day by day, as we were living in the short week, it did seem like getting more labor market data, it was like weakening, but not dropping off a cliff. And that kind of today's data kind of confirmed it, which is probably why we're not seeing too large of a reaction from the risk markets. But you did see a pretty big, I guess, relatively a big move in kind of the Fed funds futures market where, prior to today, we were looking at like a 99% chance of a 25 basis point cut on September 17th. And now we're at a 113% chance. So a 13% chance of a 50 basis point cut, which given that we have, we'll front run ourselves here. We have inflation data coming next week. Doesn't really seem like you're really going to get too much closer to a larger number on a 50 basis point cut. So seems like 25 is kind of dialed in here for September, but kind of the other shifts are you almost 100% chance of a cut in October and another 100% chance of a cut in December. So market is pricing in 2.9 cuts for the rest of the year. And if with only 3 meetings, it seems like we're going to go 25 each way. And then if you even look forward, we're looking at before the end of next year, 6 cuts. So 150 basis points in rate cuts over the next 15 months. So it seems like it's pretty solid there in terms of the rate cut market and kind of what's pricing in, pretty consistent in terms of maybe the market's thinking that that weakening labor market is going to continue, as you said, not fall off a cliff, but can just continue to weaken, so we can continue with pretty consistent rate cuts here over the next 15 months or so. But that's it from the Fed fund side of things.
And I would just add, like, it seems like 25 basis points is pretty much in the bag for September. The only way I would imagine you getting a 50 basis point move is if, like, we start to see equity markets start to sell off and, financial conditions start to tighten. It really seems really difficult to get to that number just through the economic data alone that we're going to see between now and the FOMC meeting.
And I totally agree with that. I guess one of the things we can keep an eye on here for next week is on Tuesday, we do get the BLS benchmark revision. So that could be a huge negative, even though it was like a negative 800,000 or something last year. The market didn't really react too much to that. So maybe that's not going to be as market moving there, but we do get PPI on Wednesday. We're looking for a pretty, PPI month over month to be 0.3 down from 0.9 last month. We get CPI on Thursday. That's looking in CPI headline expected to be 2.9 up from 2.7 last month. Ex-food and energy is supposed to be flat at 3.1. So unless that kind of shifts one way or the other, probably shouldn't affect Fed funds futures rates there. And then obviously we get jobless claims on Thursday. And then just another thing on Friday, we get the University of Michigan consumer sentiment that tends to be a little bit lower than people were than kind of the data would suggest, but maybe that hard data is kind of catching up to the soft data now. But should be an interesting week, inflation week next week, and then shouldn't be any. I think we're on the Fed blackout period, so shouldn't be any more Fed talk next week before the Fed meeting on the 17th. I guess with that kind of wraps it up for this week.
Yes, thank you all our listeners out there today on DL Minutes. Hit us up on X at DLine Minutes, or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
Don't forget to check out our YouTube channel, youtube.com/DoubleLine Capital. We posted the latest episode of Channel 11 with Ken Shinoda. The title is "It's Getting Hot in Here." I watched it this morning. Obviously a good August review here, given the temperatures here in Southern California, been pretty hot. And we also have Jeffrey Gunlock and I think Ken Shinoda doing a total return webcast on Tuesday. It's 1:15 Pacific, 4:15 Eastern time. Always, great to hear what Jeffrey and Ken are thinking about markets and, on the macro side of things. So with that, thanks for tuning in. I hope everyone has a great weekend.
Thanks, everyone. Take care.